Hello and welcome to another video on inventories. This is Dr. Rao. Today I'm going to talk about the conventional retail inventory method. I'll talk about this method briefly and work through an exercise and explain it in detail. So to start with, we need to understand when a company is allowed to use the conventional retail inventory method. So for retail companies, when there's an observable pattern between cost and retail prices, they are allowed to use this method to estimate their ending inventory. This is largely to simplify the process at the end of the period. This is a very common method that is used by large retailers in America, such as Walmart, Target, Best Buy. All of them use this method. So it behooves us to understand this method, see what the benefits of this method and what are some of the limitations of this method. So before we get into this exercise, let's talk about a couple of terminologies that are very common in retail. We all know what the original selling price of an item is. That's the cost plus the original markup gives us the original selling price. It's not uncommon where a retailer may choose to increase that selling price if they think it's going to be in high demand over and above that original selling price. That increase is called a markup. So the markup may be, let's say for instance, the original selling price is $10 and it's marked up to $12. That's $2 more. That's an additional profit they're going to make. A company after a certain period of time can choose to drop that markup. If it drops the price up to $2, it's called a markup cancellation, bringing it back to the original selling price. Along the same thinking, a company may choose to temporarily mark down an item. They may mark down an item in order to move the inventory, or there could be a variety of other reasons they mark down the inventory. Now, this could be a temporary thing in which they're marking it down. This is from the original cost, they're marking it down a little, but they're not going below this cost of the item. So they're just giving up some of the original profit that they were going to have over here. So that's called a markdown. They can choose to take out that markdown, and that's called a markdown cancellation. So if they take away the markdown and bring it back to the original selling price, that's a markdown cancellation. So the reason we need to discuss this is because we need to see how we're going to put it in place in our calculation. So the objective over here is to calculate a cost to retail ratio of the cost of goods available for sale. If you recall, cost of goods available for sale is the beginning inventory plus the net purchases of the current period. Plus we're going to add a few items in over here and we're going to see what they are. So let's quickly look at what items have been given over here, what accounts. We have revenues, sales revenue, sales return, markup cancellations, markdown cancellations, freight in on purchases, purchase at cost, purchase at selling price. That is basically the cost to retail that we're talking about. The purchase return at cost, purchase return at selling price, beginning inventory at cost, and beginning inventory at selling price. So I'm going to have two columns over here, and these two columns are going to be my cost and retail columns, and I'm going to see where I'm going to place the item. We always start with beginning inventory. So the beginning inventory, I've been told that cost is $30,000. That number is given to me. And the retail value is basically saying, I think I can sell it for $46,500. The next I'm going to list is purchases. My purchases, I'm putting this in the inside column. At cost is $48,000. That's a number over here. And at retail, the selling price is $88,000. These numbers are given to me. Next, I'm going to list any purchase returns. Purchase returns in this case are $2,000 at cost, and it is $3,000 at retail. Okay, the reason I'm subtracting these over here because once I return it, it's no longer available for sale. Now, if there was any purchase discounts and allowances, I would have it in this column, the cost column, but I would not put it in the retail column. It wouldn't appear over here. It's only in the cost column because it adjusts the cost of the purchase over here. The next item I have is freight in, and freight in over here is $2,400. the 2400. This doesn't do anything for there is no retail value for the freight in. Freight in is basically transportation, what I paid to bring the inventory in for me from the manufacturer. I brought it in and I paid $2,400. There's no retail value to that. Okay. So now this will give you my net purchases. And my net purchases, I want to put these in the outer column, I'm sorry, is going to be the 48,000 minus 2,000 plus 2,400. Do the same thing over here to arrive at 85,000. It's the 88 minus the 3,000. I have my net purchases. Okay. Now we're going to put the markups and the markup cancellations are up over here. Okay, because they're basically an adjustment over here that we are making because this is going above the original selling price, the markup and markup cancellations. So we have those numbers and those will be over here. So the net markups are going to be 8,500. Notice I don't put anything in the cost column for this because markups and markup cancellations relate to the selling price, has nothing to do with the item that I purchased. Okay. There's one more item over here. I'll come back to it later on. I now calculate a subtotal. Subtotal is just adding up these numbers over here. And I have 78,400. And here at retail, it is $140,000. Now the cost to retail that I calculate, I'm going to highlight it over here in a color that we can see. The cost to retail is for this subtotal, cost of goods available for sale. 78,400 at cost, and at retail it's $140,000. So this gives me the cost to retail ratio that I need. This is the important number that I need, the 56%. Okay. So of this that was available for sale, what happened? Obviously, I sold some of it. Okay. Now this is not going to appear in the cost column. It's only going to appear in the retail column. The sales were 99,000. Then I had sales returns. Again, it's only in the retail column. It's 2,000, giving me net sales. And I made a note over here, which again I had to come back to. Okay. My net sales is going to be 99 minus 2,000. Now, if there was any sales discount, I don't list that over here. Okay, it's not going to be listed over here. Okay. Now, just like we took care of the markup cancellations, I now need to take care of the markdowns and markdown cancellations. Okay. So those again are all going to be listed over here only on the retail side. And you will see that it is 6,500 over here is the markdown cancellations, the net markdown cancellations is what we're concerned with. Okay, so now let me see what I'm left with. Ending inventory at retail, I have 36,500. Okay, so it is 140,000 minus 97,000, what I sold, the net sales, minus the markdown cancellations gives me 36,500. Now that's the ending inventory at retail. This is, I walk around on the floor, the retail floor, and I can calculate this based on the inventory I have on hand. Now our last step is to calculate the ending inventory at cost. Okay. If ending inventory at retail, I'll put this in a different color here so we see this, is 36,500. I multiply that by the cost to retail ratio, and I say based on that, the cost of my inventory, ending inventory at cost is 20,440. It's 36,500 times 56%. Remember what we said? There's an observable pattern between cost and retail. So all along I've been able to observe that pattern. So I'm saying if the cost of the inventory on the floor, the retail cost, what I can sell it for is 36,500, it means the cost of the asset is 56% of that, which is 20,440. So this is the conventional retail inventory method. There are a couple other methods. This approximates the LCM method. We do not include the markdowns, the net markdowns in the cost of retail calculation. There's another method in which we will use it, but in this one we do not. Now I already mentioned that purchase discounts would be only over here. Okay. What else do we have over here? A couple other items, and I'm going to put it in a different color so you can see it. Abnormal shortages. Okay, if there are abnormal shortages, I would list it in the retail column. If I have normal shortages, those would be listed over here in the, it'll be, again, I should have, let me put a number there so you can see it. It would be in the, it'll come in the calculation after the cost to retail ratio. Along those same lines, if we give employee discounts, it should be listed over here. It's not listed in the calculation. It's not listed in the calculation for cost to retail. Basically, is it above this line or is it below this line? So keep in mind, if it's abnormal shortages, it's going to be above this line. If it's normal shortages, employee discounts, these are going to be below, which means they're not included in the cost to retail calculation. That's important to note where we're going to place these numbers. So this is the simplest of the methods in the retail inventory methods of estimating our ending inventory. This can again be done only if you have an observable pattern, which most retailers tend to have this pattern. They can use this method. So with that, this particular lesson is over. And the next lesson, we're going to talk about the conventional retail method again. We'll talk about the cost method. And we'll also talk about the LIFO retail method, which gets a little more complicated. Not very complicated, but it's a little more complicated than the conventional retail inventory method. So I shall see you at the next video.